Sup guys, Overdov here. This weekend has been absolutely crazy for crypto and the financial sector in both magnitude of the events and the speed of these events. It all started with the Silicon Valley Bank collapsing. Then Circle, the issuer of the USDC coin, announced that they had $3.3 billion in that bank and they cannot get it out. And that's around 8% of circulating supply of USDC. As a result, USDC unpegged and went down substantially to around 87 cents in the moment. It did bounce back, but recently it was sitting around 93-95 cents. Then we started having a lot of discussions and panic to some extent in the media that we're gonna have potential bank run on Monday, and that the SVB is not the only bank that has a lot of unrealized losses from holding long-term Treasury yields and mortgage-backed securities. And on Sunday we had the confirmation that another crypto-friendly bank, Signature Bank, also went down. Then on Sunday, Treasury Secretary Janet Yellen gives a statement that they are monitoring the situation, but there would be no bailout. At this point, people are panicking like there's going to be a huge bank run on Monday with the dire consequences for the banking sector. But then the same day, Fed, Treasury, and FDIC released the statements where they basically saying they bailing out both banks, and investors of those will be able to access the funds on Monday, because they basically given it the status of a systemic risk, giving it the authority to unwind both institutions in a way that is fully protects all deposits. Fed officials also said that they're creating a new bank term funding program aimed at safeguarding institutions affected by the market stability of the SVB failure. However, they're saying that there will be no bailouts and no taxpayer costs associated with any of the new plans. But I think it's more of a political statement because money is gonna come from somewhere, right? Statement says this action will bolster the capacity of the banking system to safeguard deposits and ensure the ongoing provision of money and credit to the economy. Federal Reserve is prepared to address any liquidity pressures that may arise. The Treasury Department is providing up to $25 billion from its Exchange Stabilization Fund as its backstop for any potential losses from the funding program. And I think the key part here is that securities will be valued at the par value rather than the market value assessed at the discount window. Based on CNBC here, there are about $600 billion in unrealized losses that institutions pose in held-to-maturity treasuries and mortgage-backed securities. And it's clear that banking sector in the US and probably globally is not okay with the current interest rates. That's gonna have cost and long-term consequences. Markets reacted very positively to that, obviously, crypto is up, stocks up. However, we're far from being out of the woods yet. First, there is a trust issue because a lot of people, I think, not gonna trust bank. They're still gonna go to the bank, withdraw, maybe not all of their money, but definitely some of their money. And second, and probably the most important thing here, is interest rates. What is Fed gonna do now? The market consensus basically now is that Fed will increase the rate by 25 basis points. Nobody expects 50 basis points now, and some analysts actually saying that they will not raise at the next meeting and possibly hold the raising until the banking sector stabilizes a bit, because this is the key point here. If Fed continues to raise interest rates longer and higher, the banking sector is going to be in more trouble, most likely. But they sort of have to do it to battle inflation if the inflation is not going to be cooling down, if the new data on CPI, PPI gonna come in higher than expected, it's gonna be ugly. Because at one hand, they have to raise. At the other hand, they probably have a lot of, I'm assuming, again, I don't know, I'm not an expert at that. I would assume that because it's causing a lot of negativity in the media, they're gonna be facing a lot of political pressure. So it's really tough to be Fed right now. What we're gonna see on Tuesday. On Tuesday, the SPI data come out, and I think it's gonna have a huge impact on the market because it's basically gonna dictate outlook on the inflation, and that's the major factor of the Fed's policy right now. Yeah, it's been a very interesting weekend. I'm gonna wrap up here. Please like the video and subscribe, and I'll see you soon.